Greetings, greetings. Welcome, market rebels, to this week's macro measure. I'm Wayne. My partner Ryan's working on the market outlook, which will come out later today. It's November 13th. It's a little bit in front of noon here on the East Coast. Going to flash a few things and get going. This should just be a simple slide. I'm hoping that my Windows 11 issues are cleared up. This should be a simple disclaimer, and that you've seen before if you're a regular watcher of the macro measure video. And then we should have the intellectual property rights notice, and that should really wrap us up on that. So let that flash for a second and then try to bring things under control if I can here. So hopefully what's flashing now is a group of tabs, mainly Twitter tabs, a couple other things that I hope to go through. Unfortunately, I think today will not be a short one. I don't know if I'll ever get to short. I've got to probably come up with a different format. This thing could be so much longer than it even is as it stands now. I'd like to try to bring this thing in 10, 15 minutes, but it just never happens. There's a lot going on. It's just not an easy, hey, just buy everything type of a bull market, as we all know. So it gets a little more difficult than that to really, I think, get the right context, right? To really know what we're operating in, which is always my priority, my top priority. What kind of a market environment am I operating in? And just to go back to last week, I think what we were thinking coming into last week was, don't disrespect what's happening on the bull side. We showed a lot of things that were potentially good things. It's always tough when you've got these big emotional news items like the midterm elections and like the CPI. And I think the message was, I think I said on one of my videos last week, I'll just save you the time and just wait until these things are out of the way, right? And then start trading again, unless, of course, you really have a strong inclination and high confidence and based upon great rationale or what have you. And I think this weekend's smattering of things we're going to see in these tabs will show you, right, that there's some bearish stuff out there. There's some very interesting developments, and there's bullish things. And I'm going to show you where I am on the charts. And I'm still saying, I think we've been talking about the same channel pretty much most of the year, which we'll get back into on the SPY mainly, because I just don't have the time. I don't want this to be a 2-hour video. So we'll just talk about mainly the SPY and then a few other critical things, of course, and then we'll call it a day. But what I wanted to show, right, is that people struggle. This is why I'm even going through this. People really seem to struggle with, I think, their sense of what's happening out there and maybe what should be happening in the market in their minds. And it's just something I've seen myself, well, way back when I had to learn this lesson a long time ago. And then, working with folks over the years, trying to help out, you just realize that a lot of folks suffer from the same thing that I once did. I think a lot of traders bring in, which is, how does this make any sense, right? How does this market make any sense with what's going on? And here's, a recent one from CNBC about the percentage of Americans living paycheck to paycheck, and including nearly half of six-figure earners, 63%. It's just, this is a travesty. This is really what happens when the bad actors hollow out an economy and a society, and then this is what you get. Unfortunately, it's been a ever so consistent fall from about 50 to 55 years ago, and it just keeps getting worse, unfortunately. But that's the state of what's happening with a lot of our fellow Americans. Here's a little snippet, right? This is something that is not a big deal in terms of the number of employees. Of course, I feel for them and their families, but I mean, this is only 650 people on truck brokerage giant. But again, not a great sign, right? You would think. And it's concerning to me because transports and financials and energy and material prices, things like that, really all do ultimately matter in some way. At least I like to still think so, but that's not good. And neither is this, right? FedEx is furloughing some of their workers as well. So we've heard some, I think, relatively negative news out of UPS as well. I think that Ryan's covered. And then let's take a look at another news item, right? Because this was the big thing of the week. And this is what notice, right? That there was buying with reckless abandon pretty much seconds after the CPI was released, and then it pretty much continued. And this gets into the plumbing, right? Which the market plumbing, which we reference a lot. So I'm going to talk about that a little bit, just for folks that have maybe always wondered, what is this guy talking about when he says plumbing, or the internals, the plumbing. So this is not that, but I'm bringing it up here because this is kind of what goes on, where it doesn't really matter that maybe that CPI number was kind of BSy, right? It might be some serious, there may be some serious BS with what that print was. We don't know. We can't know for sure. We'll see what happens, but we already know that a lot of these numbers are BS and they're understated. Well, this might be really, up there. So a lot of people started looking into this, and there's a lot of stuff out there around the Twitter sphere, as they say, and it's just not. It's not as clear cut as the headline number would make it out to be, and you can check it out yourself. But another sign of things, right, is that you've got this type of thing happening. A higher percentage of banks tightening credit means a wave of defaults is around the corner. We've been flashing things like the number of restaurants and small businesses that are already behind on their rent payments, and it's enormous. It's 40%, sometimes 50%, depending on what you're looking at, that we've been able to find. And that is, of course, extremely concerning because, right, you would the way that a lot of reporting is done on this, the economy is in fine shape, which again is another thing that's a little dubious, but considering all the things that we're turning up. But unfortunately, I'm still a long-term bear, and I think that there's a lot more negative fallout to come. And I really do hope to be completely wrong. I mean, I hate to see the country, hate to see people go through even harder times. But I just don't see how this straightens itself out for a variety of reasons. But if you want to know what's happening in terms of the put call ratio, or you should say call put ratio, in this case, the way they're plotting it, I guess, you got to go back to the start of the year. So we've got, this is what was going on, right? And now you've got that kind of a surge here. It's a different story. I mean, clearly, right up here, we were, I think, really stretched, and down here, valuations are a lot more reasonable. I don't know if they're reasonable in the bigger picture, greater scheme type of thing yet. I don't think they are. But as far as this goes, this is kind of interesting, right, where you were at a major inflection point, and maybe we'll see if there's a major inflection point here. But we had some for the bears. We have a little bit of just kind of notes on the market here. Here's record institutional put hedging, okay, that went on. This is institutions. Remember, they hedged earlier this year in a big way as well. They're back again doing something that dramatic, which is very interesting. And people like to make arguments as to what this means, what that means. What it means to me, and kind of the way I've been treating the UOA this year, is that just means that I'd expect more to happen. It's really telling me that this would be a source of volatility. So if I see a big hit or an interesting hit in something like SMH the way we did, and then we put ideas on around it, it's because we think that someone's expecting there to be a volatile move, something greater than what you typically would see. And that's how I've been treating the UOA, because there's been so much hedging, which makes sense in a market like this, right? So it's not maybe as crystal clear, if you want to go there, as it has been before, where, hey, they're buying slightly out of the money calls in a very strong bull market that's not overbought. What do you think they're doing here? Well, they're probably buying those calls legitimately. That's what I think. That would be my default answer in most cases. But when things get as volatile and two-sided as they've been, there's a lot of different things going on this year. And I think it's benefited us to handle it that way. But just telling me, right, that this means there could be a lot more. Either they're hedging, because they just put on new positions, or they're hedging things because they think they're overdone. But regardless, there's a lot of hedging going on, which means that someone's expecting there to be, I think, significant movement from now through the end of the year would be my guess. Very interesting that, look at this, 18th time, not that often, right, that you see this, but this was a big jump for a lot of the so-called sub-industry groups where they were up 5% or more. So you'll be up 60. And you can see that, like, of course, the post-COVID stimulus mania slash absurdity, that's part of that mix. The 2008-9 mess is part of that mix, but you didn't even see this type of action during the incredible bounces that were part of the bear market that were post March 2009. So we'll see what happens with that again, but just something that was interesting. Look at this, the most shorted stocks up 16% in the past 2 days. So if you wonder what Ryan means by this is a lot of us, this is a squeeze, right? This is it, but squeezes can turn into more. Which is why if you notice something happening like this, there's potential for that, which we've tried to make clear, all year. Remember, we've been talking about the seasonality kicking in. I can bring that chart up. I may do it, as a matter of fact. But look at this. This is incredible to be up 16%. So, right, why would a company be shorted? Well, it might be players that just don't believe it. If they think it should be valued lower. Of course, that would be the main answer, but they do like to really put the screws to that gang when markets are running. And of course, that's significant, right? You don't see that very often that happens to that extent. If you did nothing all year long, 2 days ago, bought the unprofitable tech basket, you're up 25%. Think about that. So I'm just trying to make the case for how sort of absurd in a way, right? In a few ways that what we've seen. But here's the thing, and this is where the whole plumbing comes in, right? So you've got those shorts, you've got unprofitable tech, things that people really hate. But when they can flip it around, and the plumbing is seeing this, right? That there's massive buying that's going into levered ETFs. When there's things like this, when fund flow showed no outflow. So basically, right, people refusing to really bail on this market, which is not a good sign in a way, right? If you're really in a longer term bear market, that tells you there's a ton of capitulation that's still going to need to occur. On the flip side, if we've had just a severe short-term bear market and they're reversing things, then that, excuse me, then that kind of maybe bodes well for the fact that people are going to remain confident, become even more confident, and then maybe put even more money to work. Here's another one from Ryan Dietrich. People are accusing him, of course, down here that because he does have a penchant for trying to really spin everything positively in a lot of people's minds. But this is what happens, right? 12 prior bull markets. Here's the first that looked in their first year. No one knows if one started last month, but it was up 10% in the first month, in line with other new bulls. So in other words, this is very common. This type of jam job that we've seen is very common if you really are starting a new bull market. And usually, right, later, right, the returns are, of course, better, right? You start out with a new bull, of course, as you go by 1 month, you go by 3 months, whatever, you have the returns only build because you're at the start of something, of course, start of a cycle. Another thing that I can't get into because I'm not a premium member, but 5 billion in CTA buying, 10 billion in buybacks every day. So this is what's going to be helping to support the market if this market stays in this bullish mode. So again, this is why I really talking about the plumbing, what's going on. Here's another factor on the plumbing that if you get above the 4057 level, which I believe they're talking about effectively the SPX. But if you get above that level, that's going to force CTAs in terms of the momentum following that they do to start buying $100 billion in force buying above there. So this is a great thing. I probably won't do this very often or again, but this is a great chance to show how something that's kind of, maybe you don't believe it, maybe you think it's completely, rigged, but I always note that bulls are willing to buy at the drop of a hat. You've heard me say that. My experience has been that they don't really recognize the awfulness that's out there until they're really forced to. And so they'll completely ignore a lot of things of the way that I see it only until they have no choice will they finally capitulate, because that's been the Pavlovian response the Fed has created. It's deeply ingrained in so many, and it's just been there now really for decades. And it takes something dramatic to really shake that off. Something like what we saw post 2000 or post 2008. Here's Tom Lee talking. I think this is Tom Lee, yeah, talking about how the market bottomed before Volcker changed his tactics. So he's comparing things to 82, saying, of course, right, that it's already, we're already there, and that the Fed will just really have to realize it. Then we have this comment from this gentleman, David Settle, who's talking about, I think that's the Shiller ratio, or CAPE. And I think that's a cyclically adjusted PEs, is what the acronym stands for. At least that's my memory. Anyway, he's making the argument that, right, that you can't compare the two because effectively, right, like look at the difference in where the Fed funds rate was. So real Fed funds rate was 5% then now we're negative, right, because of where inflation is relative to the Fed. So not really a great comparison, but just a couple things to think about. And then this is what we've been trying to see in sector situation, make clear, and also macro measure that this is why we were not ready to kind of dismiss the bull situation that carried it this far, because you had to give them their due, we said, just because things were improving in different ways. Now, you might not be impressed by it. You may not be a natural cheerleader like a lot of people are, but I just always think you're better off being prudent. And if you see some real things happening like we did, I think, with a lot of things starting to take off like XLI and the improvements we've seen, then you've got to respect that. And then just finally, to kind of bring this to what's something we've checked on, the percentage of stocks starting to get up there. We're using the market rebellion charts for this one, but the percentage of stocks getting above their 20-day is starting to get back towards the high levels that have preceded pullbacks again, right? And I'll do this for the 50 days as well. Let's do 50 days. Oops, I typed it in the wrong spot. My bad. Where am I? There I am. Yep, I'm going to put it in that box. I'm not sure what I was thinking on that one. Trying to get through too much, I think, but here you go on the 50-day. So this is another, right? You can see the improvement, and you can see how high we've gotten on this. And let's see if we can bring in the start of the year. So you're way up there. You're getting way up there. You have to go back to the prior to the last swoon we saw to get more than that. I should say higher than that. And then finally, where am I? Yep, I'll do the MMTH. And this is the percentage of stocks above their 200-day. So that's pretty heavy duty, right? You're really starting to get up there. But right, if you're moving back into a bull market, you would expect to. And I'm not predicting that. I'm not saying that. I'm just mentioning that keeping an eye on these. Now, finally, let's see if I can go to TNT and then wrap this section up. TNT right there. Let's go to market outlook. I think I have to go back to, just to be safe, I'm going back to a few outlooks ago, because I'm pretty sure, I don't know if Ryan has maintained keeping the seasonality in there. Yeah, but I know a few weeks ago we were still working with it and had it in there. So remember, we noted that this is really what happens. And I think a lot of people, this also starts to become a little bit of a self-fulfilling prophecy, kind of like the complaints people lodge against technical analysis. But again, if people are going to glom onto this and say, well, I'm a buyer because of this is what tends to happen. And it creates an imbalance, or kind of shifts things in the way that favors it going up, and you want to profit from that, then you should do that too. And I guess that's a self-fulfilling prophecy. But if it works out for you consistently, right, more so than not, why not utilize these things? I mean, that's always been my way of looking at it. Like, who cares? I mean, there may even be a lot of truth to it, but if it helps you to do better in the markets for you and your family, or your clients or whatnot, then why not? So, I mean, but the point is, right, this is typically what happens, and that's what we'd be fighting against. Plus, you have all those potential inflows. You've got triggers. You've got maybe too much hedging going on. Maybe you've got people now that are lagging behind that are forced to buy these highly levered ETFs to try to catch up, and that forces the buying of other ETFs and ultimately stocks, right, too. So this is the kind of internal plumbing stuff we talk about. Now, this is a great time to part company with that and get right into looking at the spiders. And I shared a few things on Cocktail Hour. It's not that Dirk did anything wrong, but it's always tough with Dirk kind of asking questions and then shifting on that, because I wanted to just lay a few things out quickly. But this, of course, was one of them. And let's just look at the year here on the SPY. And this is it. I mean, we've been working with this expanding channel for some time. I'm pretty sure that BMC, Brian McCormick, has been working with this for a long time as well. And we were even noting how there were expanding channels within expanding channels and so on and so forth. And we saw that last week. You got the breakout. We came back to it a few weeks ago. And then we talked about what happens now. It's back to where there. Does it keep going? And of course, that's what they've been able to do. The seasonality's kicked in. But I'm just looking at it and saying, right now, here we are. We just got above the 150 SMA in rust color there on the SPY. And I'm just looking at it saying, well, I still think by the time this is over, you're more than likely to come up to the 200-day, which is the purple line there near 406-ish or 407. And then maybe this resistance line, maybe. But a lot of times, right, you don't get exactly there. A lot of times you go over a little bit or you fall just short. But if you were to fall short here, right, if we were to fall short here, this to me is a bigger problem for bulls than it would first appear, potentially, because just like this has been a big problem for bears that they didn't drop even closer to the lower end of the channel, which is something we noted, and noted that I think at the time that when we've been noting this, that the RSI there on that kind of vanilla colored line, that's been generally improving. We noted these things. We noted the upsloping moving averages, things like that, that just kind of show that things were getting a little bit better. But that would be a problem, right? That if they can't do that, if they can't work this thing up a little bit higher, and that would maybe mean, right, that this was just yet another, this is nothing special. It was just circumstances. It was news items that they were able to use at the right time of the year, where many people were wrongly positioned or ill positioned, whatever you want to call it. And they've been able to work it back up. But you really can't buy into, I can't buy into this. This is a new bull market thing myself yet. I mean, I'm still more of a believer that it's more than likely we're still in more of a longer duration bear market that's got another bullish phase in it. But it hasn't, it's not as if we've taken out this high or something like that. And it's not as if we can say that we didn't just make the lowest low and bounce from it, much like you did here, right? Much like you did here. Much like you did here, you made a new low and then eventually put together bounces. Here's the same, you know, so I'm not really convinced that it's all over yet. I still think there's a lot of fallout. I have a very hard time believing it, as a matter of fact, but I don't want to get too opinionated. I really want to try to be objective in what I'm sharing with you all and how I'm looking at the charts. And what I do to be that way, actually, I need to bring in this. So this, which was now on another screen, but we'll come over here. I don't know why it shifted on me. But the reason I showed this during the cocktail hour, but I think I showed it on SMH. And the point I wanted to make, though, we can look at this now that we're on SPY, but here's your 30-minute chart. Here's your 70 RSI reading, 71 on the hourly, 72 nearly on the 2-hour. You're at 67 on your half day. Your 4 hours, it's nearly 69. There is room to go on your daily and on your weekly charts. Now, so that's the thing, right? And you've got a really powerful candle here on the weekly charts. But where did that leave us off? The problem is that we are overbought on what I call the heavier duty intraday charts right in here. And that is concerning, that you're very close to overbought with some of the gaps that we've seen. So what I said, and I stick by this, is that sometimes I'm going to review things and have second thoughts, but I stick by this one. If you trade this move because you believe that we're working our way towards 200, or maybe towards the resistance line right there, or maybe even higher, and you're going to see some of these gaps that are a little bit higher get closed, I have no problem with that. My only issue is I would keep a long trade on. If we start, let's assume that we're news neutral over the weekend, I would keep a long trade on a short leash right now because it's all already overbought. A lot of things are already overbought. However, right, and this is what I was trying to convey, if we do pull back a little bit, take some of this overboughtness out of it, and then go, I would say, look, as long as we keep making higher highs, higher lows, and support lines that we would draw in there would hold, I'd still be willing to go with the bulls again. And I'm not saying I wouldn't have it on a short leash, probably just have it on a little bit longer of a leash, right? Because there's been a corrective phase that took a lot of that short-term froth out of the market, allowed the market to maybe hold from a higher level, maybe somewhere near the 100 there in white, and then go. And if it does pull back to there and then goes, then that would be a big deal. Now, I don't want to get into like Fibonacci extensions, Fibonacci retracements, and all that kind of thing, but we did talk about that a few weeks ago, maybe even longer. And we were at the 50% retracement of the SPY of the whole entire, I think, post-COVID hyper madness in terms of monetary policy, fiscal policy that kicked in. And so you got a 50% retracement on that. And they've been really coming after stuff pretty hard ever since. And they could be working this thing back up. And another thing that would factor in would be that it could work up towards what will be the 23.6% retracement level to see how it works, see how it acts there. But I would really wait to be a more aggressive bull. I'd want to see pullback, momentum shift back in favor of the bulls. And then I'm thinking that helps them to sustain the rally longer as usual. If in fact they don't do that and they just keep going, I still think there's a trade there. In fact, I put an SPY trade in late on Friday for UOA Pro, but I'm really think you should be smart and just realize that you're intraday overbought. So that's where I still am really on those things. But I want to show just a few things from sector situation that I'll do in a little while, just to show you why I'm a little concerned, right, about what's been happening here. And you can see the kind of vertical nature of the industrials, the vertical nature of this move. And, I'm not a big fan of vertical moves if I haven't traded them and done well with them, right? If I've done really well, of course I'm a big fan if I were on it. But if I show up to something someone asks me to look at and I see that it's made this really long extended vertical move, it concerns me because I know the other side of a vertical move is much like this, the way up. And so you can go right back down very quickly when you build your price structure that way. Same thing kind of happened there in XLB. I don't want to belabor the sectors, but if I kind of show the vertical nature of this with the gaps, nonetheless, it's there, right? And these moves have been extreme, and we had a tremendous trade. I hope a lot of folks did well on this one. That we had a bullish trade that triggered, I think, somewhere near 201 or 202 in SMH. I think the idea expired on Friday. I can't remember. There's so many trades and things I look at, but this is just for a 3-day move, though. This is absurd, right? This is one moment you're at one, and this is your SMH semis. Right, one moment you're on a low of near 194-ish, and then here you are, and you're near 222. It's 3 sessions later. I mean, just think about the percentage move. It's not just one stock doing that. It's obviously, right, a group of stocks. So that's just incredible movement. And just note, interestingly, right, that you're just at 70. So you're not even like at 80 or 85, something crazy on RSI. Your 200 still up here. I'm not charting this. I'm just saying that, just to kind of make a note, this is an important sector and it is overdone, but it's not as overdone as I would have thought given what it did. But I guess that's just because it's the way the calculation works, that it really wasn't. Maybe it was starting out from nothing special level, but recently. Now let's take a look at this on overbought, oversold. And why is this doing this? This should be filling in. I hope I'm not getting some kind of an issue here on that's strange. that that's not shifting for me that way. We're a little worried here about internet connection. That's not good. I don't know why that's doing that. So odd. Well, let's get away from that then. Let's just cover a few more things and then we'll call it a wrap. But with the Qs, we always take a look at SPYs, Qs, IWM, diamonds. These are lagging, right? But you really do have to I think if you're just looking at it objectively and you're a technician, you have to always like more of a positive divergence from this low to this low. And you see that some people say, well, it's not the same. You can't be a positive divergence, but you could just call it natural healthy improvement on the second low then, whatever you want to call it. But there you go. I mean, that looks pretty good. It kind of looks like a W, does look a little bit like a double bottom. And, you just can't with the big, I'm sure they're going to want to get the big names up. They look primed to go. I mean, they are only at 60 on the RSI. Could they keep going to the 200? There's gaps right in here that I can see through all that mess that I've got up there. But the point is, like, that is not a chart, right, that started rolling over yet. And I'm just a big believer that you wait for the momentum to begin to shift before getting involved in something. I don't like assuming that the momentum will shift at a certain level. It just doesn't work out that well for me, or hasn't worked out that well for me over the course of time. Yeah, sure, sometimes things worked out great, but I'd say far more than often things go a little bit further than you expect, or they don't exactly come to your level and you've got to react sooner. Now, why would IWM also be doing this? Come on, guys. Why is this happening? I hope I'm not hitting thinkorswim maintenance. Oh, geez. I think my internet connection is fine. So I'm not sure why that's doing that. And this is a very simple chart too. So I don't have an answer on that. That is odd. I wonder if it'll let me bring up anything like copper or whatnot. No. Very strange. Thinkorswim seems to be still functioning, and yet I can't get anything to populate here for me. We try another chart maybe that's, yeah, it seems like some of them are still fine and some of them are really struggling. So that's unfortunate. I may have to wrap here because this is not possible, making it impossible for me to do anything no matter what I shift to. Let me just shift to one last thing and just see if I can get XLE even just to get one simple ETF. No. Well, I apologize. Well, maybe I'm back. Maybe I'm back. Boy, that is tough. Let's go back and try to cover the QQQ. We talked about that. See if that comes back up. Now, man, diamonds maybe? Some things are working and some things aren't. Yeah, I'm going to have to wrap it here. I apologize to everyone. This is super frustrating for me that I'm getting this kind of difficulty from thinkorswim right in the middle of this. I don't know if they're doing maintenance, what's up with this, but I know over the weekends they do this stuff sometimes. And I'll probably have to hope that I can get it together for the sector situation. Well, I may try to include some of this stuff in sector situation if I can get a working thinkorswim. I don't have any data issue according to thinkorswim, so I don't know why this is happening. I don't have any memory issues going on. Just odd. Well, I'm sorry about that, gang, because I was planning on covering, IOIR, LQD, HYG, the VIX, dollar, TNX, like we typically do, just briefly. But I'll end on this, and I'll just say that right now the bulls are in control. It would probably serve them well if they did get a little bit of a pullback here, then see what happens, and if they start to go again, right, then get on board, see how that rally develops. But this is really the key to the key or secret to trading is being someone that's good at adjusting. I think that's the holy grail that a lot of people never find because it's not as not as interesting or what have you as maybe they'd hoped. But the holy grail to me is just being smart about your adjustments consistently and sticking with your discipline that you've worked out for yourself. And I think that's what we have to do, because you can certainly say that we're a little bit more rallying, you're getting too far and it's gotten a little ridiculous and the things are still really terrible. At the same time, the plumbing being what it is, the internals, they could keep going with it, right? It wouldn't make any sense. It would be irrational, but they could keep going with it. And that would suit them just perfectly, right? Because that's what they want to do by the end of the year. On the flip side, maybe it starts to sink in that this is all a mirage, right? That the 7.7 wasn't anything close to real, that real interest rates, are still too low relative to where inflation is, where it is likely to remain. And now we have these permanently elevated prices that can't possibly help consumers. So there's a lot of things to digest there, but I'm really saying bull's still in control. I feel better if we get a nice pullback, get some ideas to go long, go with that. If that momentum returns, we start taking out the high that we put in Friday, great. If it doesn't, it fails, right? It could be that they moved too far too fast and it's got to correct more before we even see more upside. So sorry about the tech issues there, but clearly it's a big problem. And I'm not going to recover from it, maybe until I get into the sector situation. So everyone take care and please accept my apologies.